If you own silver right now, I need you to pay close attention to the next 60 seconds, because what I'm about to show you is something that most silver investors never figure out until it's too late. Silver has done something extraordinary over the past year. It crossed $100 per ounce for the very first time in history. People who bought silver 2 years ago have seen their money more than double. On paper, silver investors are winning. The charts look great. The headlines are positive. Everything seems fine. But here's the uncomfortable truth that nobody in the silver community wants to say out loud. A lot of silver investors are losing money, even as silver goes up. Not because the market is rigged, not because they made a terrible decision buying silver, but because they never looked at the real math behind what they actually own. They're watching the spot price climb and assuming that number is their return. It's not. In this video, I'm going to walk you through 4 traps that are hiding inside your silver investment right now. 4 traps that are quietly eating your returns in ways that never show up on a price chart. And by the end of this video, you'll know exactly how to calculate what you're really making and how to restructure your position so you actually keep the gains that silver is handing you. This isn't doom and gloom. My name is Danny, and I own silver myself. I believe in the thesis. But there's a massive difference between buying silver and investing in silver intelligently. And most people, even the ones paying close attention, are doing the first one, not the second. Let's get into it. Let me ask you a question. When you bought your silver, coins, bars, whatever form, what did you actually pay per ounce? Not the spot price, not the number flashing on a chart. What did you actually pay when you handed over your money? Because if you're like most silver investors, the number on your receipt was higher than spot. Sometimes a little higher, sometimes a lot higher. That difference is called the premium, and it is the single most common reason silver investors end up disappointed, even in a bull market. Here's how it works. The silver spot price is what large institutional traders pay for enormous quantities of silver in the wholesale market. You are not an institutional trader. You are buying a retail product, a coin, or a bar that has been mined, refined, minted, packaged, insured, and shipped to a dealer. All of that costs money, and you pay for it up front, on top of the spot price, every single time you buy. A standard 1-ounce American Silver Eagle, the most popular silver coin in the world, typically trades at a premium of 15 to 20% above spot, sometimes even more when demand is high and supply is tight, like it was throughout much of 2023 and 2024. Silver rounds and generic bars carry lower premiums, usually 5 to 10%, but there is always a premium. It never goes away. Let me put that into real numbers so this becomes concrete for you. If silver spot is $85 per ounce today and you're buying American Eagles, you're probably paying between $98 and $102 per ounce. That means silver needs to go from $85 all the way up to $100 just for you to break even. Before you make a single cent of profit, the market has to hand you a 15% gain first, just to get you back to zero. Most investors never think about it this way. They look at where they bought and compare it to the current spot price and call that their return. But that's not your return. Your return starts from what you actually paid, including the premium, and ends at what you would actually receive when you sell, which is also usually below spot because dealers buy back at a discount. So here is what I want you to do right now. After this video, go find your receipts. Add up the total amount you paid across every silver purchase. Divide it by the number of ounces you own. That number, not the spot price on the day you bought, is your real cost basis per ounce. Write it down somewhere, because that is the number that actually tells you whether you're making money or losing it. Everything else we talk about today builds on knowing that number. Alright, so now you know your real purchase price. Now let's talk about what it costs you every single year just to keep what you already own. Because this is the part of silver investing that almost nobody talks about. And it's not dramatic or exciting, which is exactly why it's so dangerous. It's just slow and quiet and relentless. Physical silver has what's called a carrying cost. And that carrying cost is silently reducing your real return every single month, whether you're paying attention to it or not. The first carrying cost is storage. If you keep silver at home, you need a safe. A decent fireproof, theft-resistant safe costs anywhere from $300 to well over $1,000, depending on the size and quality. That's a one-time expense, but it's a real cost that needs to be spread across the ounces you store in it. More importantly, if you're storing meaningful value at home, you should have it properly insured. Most standard homeowner or renter insurance policies have extremely low coverage limits for precious metals, often just a few $100s total. To properly insure $10,000 worth of silver stored at home, you're typically looking at an additional $100 to $200 per year in insurance rider premiums on top of your existing policy. If you use a professional vault or secure storage facility, which I personally recommend for any position above $10,000, you're paying between 0.5% and 1% of the value per year. On a $10,000 position, that's $50 to $100 every year. On a $50,000 position, that's $250 to $500 a year, just to keep it safe, every year, whether silver goes up or goes down. Now let me show you why this matters more than it seems on the surface. If silver goes up 10% in a year, which would be a decent performance, and you're paying 1% annually in storage and insurance, your real return is 9%. That doesn't sound like a big deal, but compounded over 5 or 10 years, that gap adds up to a significant amount of money. And here's the thing that really gets people. The premium you paid to buy, combined with the annual carrying cost, means that silver needs to perform better than most investors realize, just to match what you could earn with simpler, lower-cost alternatives. You're not just competing against the spot price, you're competing against your own cost structure. None of this means don't own physical silver. Physical silver is real. It cannot go bankrupt. It has no counterparty risk. It exists regardless of what happens to banks, or brokers, or financial systems. There is a very real and important role for physical silver in a serious investor's portfolio, but the mistake, the trap, is assuming that 100% of your silver exposure should be in physical form, because once you run the math on carrying costs, the numbers simply don't support that at scale. I want to tell you about something that happened in February 2026, because it is one of the clearest examples of silver investor psychology I have ever seen. And it happened just weeks ago, so it's still fresh. Silver hit an all-time record high of $121 per ounce in late January 2026. It was everywhere. News headlines, social media, YouTube. Silver investors who had been patient for years, some of them holding since silver was at $20 or $30, were finally seeing the kind of move they had always believed was coming. The mood was euphoric. People were talking about silver going to $200, $300. And then, in the first 2 weeks of February, silver crashed. It fell from over $120 all the way down to $63 per ounce. That is a 48% drop in under 3 weeks. In that window, a very large number of retail silver investors panicked and sold. They had held through years of frustration. They had watched silver go from $30 to $120. They had waited and waited and waited, and then, at exactly the wrong moment, when the volatility became too much to handle emotionally, they sold. They sold at $65. They sold at $68. They sold at $70. And now, as of today, silver is back above $85 and has been climbing steadily since the Lunar New Year buying wave came back into the market. The people who sold during the crash locked in a real loss. The people who understood what was driving silver, who knew about the structural supply deficit, who understood the industrial demand from solar panels and electric vehicles and AI data centers, who had a framework for why they owned silver in the first place, those people held, and they are being rewarded right now. This is not a story about silver being risky. Every investment that can go up significantly can also go down significantly. That is the nature of investing. This is a story about not understanding what you own and what that lack of understanding costs you at the worst possible moment. Here is the key insight. When you understand why silver is moving, when you know that the market has been in a structural supply deficit for 6 consecutive years, that 70% of silver production comes as a byproduct of mining other metals and cannot easily be increased, that demand from solar and EVs and AI is growing faster than any supply response can offset. When you know all of that, a short-term crash looks completely different to you. It doesn't look like the end of the story. It looks like volatility inside a larger trend. It looks like what it actually is, which in February 2026 turned out to be a buying opportunity. The investors who sell at the bottom are almost never the ones who understood the fundamentals deeply. They're the ones who bought silver because it was going up and sold because it was going down. That's not investing. That's reacting. And reacting to price is the most expensive habit any investor can have. Here is one simple thing I want you to do before you buy any silver position going forward. Write down in 2 or 3 sentences exactly why you own it. What is the core thesis? What specific specific things would have to change for that thesis to be wrong? And then, the next time silver drops 20 or 30 or 40%, go back and read what you wrote. Ask yourself whether any of those things have actually changed. If they haven't, you have your answer. This one gets almost no airtime in the silver investing community, and that's a mistake because it can quietly eliminate a very significant chunk of the gains you worked for. In the United States, and many other countries handle this similarly, physical silver is classified as a collectible for tax purposes, and collectibles are taxed very differently from stocks, bonds, or real estate. The long-term capital gains rate on collectibles in the US is capped at 28%. The long-term capital gains rate on stocks for most investors is 15 or 20%. That gap might not sound enormous, but when you're sitting on a large silver gain, it translates directly into thousands of dollars. Let me make this concrete. Say you bought $10,000 worth of silver at $30 per ounce back in 2023. At today's price of $85, that position is worth roughly $28,000. Your gain is $18,000. At the collectibles tax rate of 28%, you owe about $5,000 in federal tax on that gain. If that same gain had come from a stock, at the 20% rate, you'd owe $3,600. The tax treatment alone costs you an extra $1,400. On larger positions, that gap becomes tens of thousands of dollars. Now here's where it gets more nuanced. Different instruments are taxed differently. A silver ETF may or may not be treated as a collectible depending on its structure. Some are, some aren't. Silver mining stocks are taxed as ordinary equity securities, which means they get standard capital gains treatment. Physical silver held inside a self-directed IRA has its own separate set of rules that can significantly change the tax math. And if you live outside the United States, your country has its own framework entirely. Some countries have no capital gains tax on precious metals at all, and others are more aggressive than the US. The trap here is not that taxes exist. Everyone knows taxes exist. The trap is that most silver investors calculate their returns on a pre-tax basis, compare those pre-tax returns to other investments that are taxed at a lower rate, and draw completely wrong conclusions about how silver is actually performing in their real financial life. A silver position that appears to have returned 40% might actually have returned 28% after tax. A mining stock that returned 35% might have returned 28% after tax at the same rate. Those are different situations, and you cannot make good decisions about your money without understanding them. I want to be clear, I'm not a tax advisor, and nothing in this video is tax advice. But I am telling you with complete confidence that before you make any large decisions about selling a silver position, you should spend an hour with a tax professional who understands precious metals. That conversation will almost certainly be worth more than it costs. Alright, we have spent most of this video talking about what can go wrong. Now let's talk about how to get it right, because all four of these traps are completely avoidable if you structure your silver exposure properly from the beginning. The investors who make real, consistent money in precious metals don't just buy silver and hope. They think about their silver position as having three distinct layers, each one serving a specific purpose in the overall portfolio. The first layer is physical silver. This is your foundation, coins and bars that you hold directly that you don't plan to sell in normal market conditions. This layer exists for one reason: to protect you against systemic financial risk, banking crises, currency failures, extreme inflation, scenarios where the financial system itself is under stress. Physical silver performs that function better than any paper alternative because it has no counterparty risk. It doesn't depend on anyone else's promise or solvency. For most individual investors, this layer should represent somewhere between 30 and 50% of your total silver exposure. And when you're building this layer, your focus should be on managing the premium. Buy well-known government-issued coins or large branded bars from reputable dealers, and always calculate your real cost basis as we discussed. The second layer is a silver ETF or fund. This gives you direct exposure to silver prices without any storage cost, without any premium over spot, and with complete liquidity. You can buy and sell in minutes from your phone. The management fees on the major silver ETFs are very low, typically a fraction of a percent per year. This layer captures silver's price performance in the most efficient and cost-effective way possible. It's what you use when you want more silver exposure, but you don't want to pay the carrying cost of storing additional physical metals. metal, this layer should be around 30 to 40% of your silver exposure. The third layer is silver mining stocks. This is your performance engine. During a strong silver bull market, well-managed silver mining companies can outperform the metal itself by 2 or even 3 times because of something called operational leverage. When the silver price goes from $50 to $100, a miner's revenue roughly doubles, but their production costs stay roughly the same. So their profits can triple or quadruple on the same revenue move. That's the leverage. The risk is that you're buying a company, not just the metal. Management quality, geopolitical location of mines, production costs, and debt levels all matter. So keep this layer smaller, around 15 to 25%, and spread it across more than one company rather than concentrating in a single miner. Together, these 3 layers give you the security of physical metal, the cost efficiency of ETFs, and the performance potential of equities, while managing the premium trap, the storage cost problem, and the tax exposure we talked about in previous chapters. The ratio between the layers isn't permanent. It should evolve based on where we are in the silver price cycle and your personal situation, but the framework stays constant. Let me bring everything together. Silver right now is in one of the most structurally compelling positions it has been in for decades. 6 consecutive years of supply deficit, industrial demand from solar energy, electric vehicles, and artificial intelligence infrastructure that is growing faster than mining supply can keep up with. Physical investment demand forecast to rise 20% in 2026, according to the Silver Institute. Central banks and sovereign wealth funds entering the silver market directly for the first time in generations. The fundamental case for owning silver is as strong as it has ever been, but the opportunity is only yours if you don't fall into the traps that are quietly destroying returns for the majority of people who own silver right now. Know your real cost basis, not the spot price on the day you bought, the actual total you paid including premium. Calculate your annual carrying costs and subtract them honestly from your expected return. Understand the fundamental thesis deeply enough that you can hold through volatility without panicking. Get clear on your tax situation before you make large moves, and structure your silver exposure across all 3 layers: physical, ETF, and mining stocks, rather than putting everything into one form. Silver is not a complicated investment, but intelligent silver investing requires the same discipline, the same framework, and the same honesty about the real numbers that any serious long-term investment requires. And now you have that framework. If this was useful, subscribe. I post every week on precious metals, portfolio strategy, and how to protect and grow your wealth in an uncertain world. And if you want to go deeper on the supply deficit, the gold to silver ratio, or how to evaluate individual silver mining stocks, I have dedicated videos on all of those linked below. I'll see you in the next one.